right, it's time now for Hot Picks. We are looking for them in the retail sector. Let's bring in John Sanmarco, who's portfolio manager at Neuberger Berman, where they run over $400 billion. And John, you actually recently launched an actively managed ETF to track the consumer, your best ideas in the consumer, ticker NBCC. It's outperformed the retail sector in the short period that you guys have been around. But just give us some insight into how you think about stock selection, given the environment that we're in right now.
Yeah, great to see you, Amber. Thanks. We run an active process that is highly data driven, and it's an interesting time to be having this conversation because the data is pointing us to two somewhat contradictory places. On one hand, the middle income consumer and the low income consumer have depleted or just about to deplete all of their excess savings. So they're really looking to stretch their dollar. And the data is pointing us to places like Walmart and Dollar Tree that offer stuff folks need at great value. But on the other hand, the high end consumer, where most of the remaining excess savings are concentrated, is in pretty good shape. Their balance sheet's in great shape, and there's a lot of luxury names in an industry we like position to benefit, not just from that U.S. phenomenon I described, but the China phenomenon is just getting started, where there's a ton of pent up savings that we think get unleashed and should help the luxury space as well.
Okay, so let's talk about that, because your first pick, Moncler, fits perfectly into that China thesis. But there's also been a lot of people who piled into stocks for China, and it blew back on them. Well, Apple's higher, but struggled there. Starbucks is another example. Canada Goose here also struggled in China. Moncler its shares have been resilient. So what is Moncler doing that the others are perhaps misstepping in?
Yeah, this is a name where we really rely on what the alternative data is showing us, and we focus a lot of our work here on understanding how the consumer feels about the brand, how scarce and desirable the brand is, because that's going to really dictate pricing power and the success of new product. So the data is all very constructive there. We think this is a beloved brand in China and globally for that matter. And what Moncler has that a lot of other luxury names, or a lot of consumer names for that matter, don't have is a ton of white space expansion opportunity. And that's new stores, that's continuing to grow their digital penetration, it's new customers, it's new products. And because the brand's so healthy, we can invest behind the likelihood that they succeed expanding into that white space.
Do you view Canada Goose as a competitor there, and how does it stack up against a name like Canada Goose?
Sure, it's still they sure look alike on paper, don't they? You see them in many of the same retailers, in some cases at the same price points, and I think that's really why it's important to do data analysis that goes several layers deep. We always like to say we'd rather be 1,000 miles deep on a name or a topic than 1,000 miles wide. And we think Moncler's brand equity is really in a class of desirability of its own. And that's not a knock on Canada Goose, so much as a compliment to the Moncler brand and the job they've done building that brand.
One of the stocks that was also, for a time, quite an outlier in what was going on in retail was Aritzia, Canada's Aritzia, which has, gone gangbusters in its in its global expansion, particularly in the U.S. at a time where others were struggling. But it's waffled recently. What do you continue to like about Aritzia?
Sure. Again, I'm going to go back to the data. And in this case, what the data show us is, number one, while this is a more accessible luxury price point, it's actually quite an affluent clientele. So we think their loyal customer is positioned to continue to spend resiliently. And then, we also see this, might I even call it like a cult-like following from these young emerging professionals who are just highly engaged in the brand, much more loyalty than we typically see in products like this. And then finally, you touched on it in your question, but it's really attractive to us is the store growth opportunity. I mean, they're at 115 or so stores today. Management has made what we consider pretty achievable commitments to growing their square footage 60% in the next 5 years. We think they could probably grow faster than that. we certainly don't mind them moving at a conservative, measured pace of growth. But in the long run, we think the store count could be 3 or 4 times higher.
It's interesting that you mentioned the engagement, because this seems like one of those, brick and mortar stores that has managed to really nail Instagram marketing. And I'm surprised myself on how much I'm actually buying more and more through Instagram, things that I see through there. Do you have a metric, or do you have a way of tracking like which retailer is coming through on those kinds of social media platforms?
Yeah, absolutely. We track all of that. We track just the quantity of engagement as well as the quality of engagement. So, whether folks are liking posts on Instagram as one, kind of cursory example, and the degree of positivity with which they're engaging with a given brand. And Aritzia seems to be a really beloved brand by those metrics and others.
All right. And lastly, this is definitely a more beaten up name, FarFetch, which is a big online platform. So you're kind of picking this up off of a lows. Why is it down so much? And what do you think the upside is here?
Sure. So let's start with why is it down so much? I think to some extent they got caught up in the type of security it is. It's a high growth, long duration tech name that frankly, doesn't have much track record at all of profitability. They've kind of waffled around break even. We like it because, we think that profit part of the story gets immediately and meaningfully better. And part of the reason we have confidence in that is of the 4 billion or so in GMV that we expect them to add in the next 3 or 4 years. The vast majority of that is what we would call like highly visible growth. These are contractual agreements with new partners. Certainly not a guarantee or a slam dunk, but we think that the probability that they're able to deliver at least that level of GMV growth is very high. And then if you look at consensus estimates, who GMV growth being the total volume growing through the system. If you look at consensus revenue estimates, they've got about $2 billion of growth forecasted over that period of time, and just an incremental $400 million in EBITDA. So that strikes us as a really achievable, if not beatable, level of profit improvement. So we think as you see the P&L get better and start to heal, FarFetch could separate itself from other growthy e-commerce names that, frankly, aren't making money and still may not be making money several years from now.